Ta-da. Kick this off. So hello to everybody and welcome to this month's presentation of Law at the Library, which is a partnership between the Evanston Public Library, the Chicago Public Library, and the Chicago Bar Association. My name is Lorena Neal, and I'm the Legal Literacy Librarian at the Evanston Public Library. And we're delighted to have everyone here tonight to discuss this evening's topic, cleaning up your credit. Our presenters for this evening are Kevin Liu, Alan Ritchie, and Pat Huber of Pilgrim Christakis LLP. I'd like to tell you a little bit about the format for this evening, and then we will get things started. Our lawyers will give their presentation on important things to know about credit and debt, and then we will have a question and answer period. So if you have any questions, please type them into the Q&A window, which you will find near the bottom of your screen, or you can also use the chat feature to ask your questions there. Your questions will be collected as they come up, and the presenters will be given the opportunity to answer them at the end of the slideshow. So feel free to add your questions whenever you think of them during the course of the presentation. If you have any technical issues or questions, feel free to direct those to me in the chat as well. Our next Law at the Library presentation is going to be on Tuesday, February 22nd, and the topic will be buying and selling a home. So I will post links to register for this next session in the chat if you're interested. I also want to remind you that the Evanston Public Library does have legal information sessions on Monday and Thursday afternoons from 2 until 4 p.m. If you have legal questions, we will help to refer you to the proper organizations and attorneys who may be able to help you with those problems. So contact the Evanston Public Library if you're interested in setting up one of these appointments. And now I'd like to turn things over to Alan, Kevin, and Pat. Would you like to say a few words before I start the slideshow here?
Thanks, Lorena. I'll go ahead and start out. My name is Pat Huber. Like Lorena said, we work at Pilgrim Christakis, which is a firm that's located in River North that provides financial services litigation to clients engaged in a variety of different industries, including retail banking, mortgage lending, auto finance, credit cards, short-term lending, and debt servicing and collection. So we're honored to be here. We're honored to talk with you about a little bit about credit reports and credit scores. This is truly kind of our bread and butter. This is what we do on a day-to-day basis. I'll start out by talking about credit reports and what you can do to improve your credit reports. I will say that I'll be monitoring the questions as they come in. I'll do my best to kind of address them. But we'll also reserve some time at the end if some questions go unanswered during the presentation. And after that, my colleague Alan will be talking about what is a credit score and how to improve your credit score. And Kevin will be he'll be playing cleanup. He'll talk about ways to deal with your debt and how to avoid scams related to debt, credit, and so first, when we're talking about kind of cleaning up your credit, I think it kind of bears talking about why that matters. Lorena talked about your next presentation will be on buying a home, and so this is seems like a timely presentation, and worth mentioning that I think that when we're thinking about credit scores and we're thinking about credit reports, we're thinking about people who are out to loan you money. Talking about creditors, mortgage lender, auto lenders, and money will simply be a lot cheaper if your credit score is higher. If creditors look at your credit report and they deem you to be a more reliable or more trustworthy borrower. So most basically, Lorena, you can go ahead and switch to the next slide, please. The credit report is a file. It's about you. It's full of information on where you live, how you pay your bills, what kind of credit you have currently and what kind of credit you've had in the past, and whether you've been sued, arrested, or filed for bankruptcy. These credit reports contain information that are compiled by 3 major nationwide consumer reporting agencies, or CRAs for short. You've likely heard about these CRAs, unfortunately, probably in the news because they've been the subject of large class action litigation. And these companies are Experian, TransUnion, Equifax. And one of the reasons why we see these featured so frequently in the news, or maybe fairly frequently, is because these credit reporting agencies deal with a lot of very private information. They compile this information and they sell the information in your file to creditors, insurers, employers, even landlords who are deciding whether you should be given a lease for an apartment or other type of rental. Really, the importance of credit scores goes beyond merely kind of a long-term loan. It increasingly tells us, where we live, how we live, and where we bank and where we work. I want to talk a little bit about the kind of information that is on a credit report. Lorraine, I think you can go to the next slide. That includes personal information. So it would be your name, your address, your date of birth, your social security number. Most critically, it'll include your payment history. So it'll include a number of different accounts that you have, revolving credit line accounts, also accounts that are maybe secured via a home or via an automobile. It'll include your payment history on those accounts, whether you've made payments on time, whether you've been a week late or maybe a month late, or maybe even a couple months late. And when potential lenders are looking at that information, or potential employers are looking at that information, they're trying to determine whether you're trustworthy, whether you're going to fulfill your end of the bargain. There are also a number of different inquiries that are noted on your credit report. There are what we call soft inquiries. Soft inquiries are inquiries that can only be seen by you when you access your credit report. And these types of inquiries are most commonly promotional inquiries. So it could be a credit card company, for example, that sends you an unsolicited offer for a credit card. So you might open your mailbox and see an offer from Chase or Capital One or Discover. And you might look at the envelope and say, well, I didn't apply for a Discover card. I didn't apply for a Chase card. But these credit card companies have sent you an offer after they've looked at your credit report without you asking them to do that. This is what's called a soft pull. So they're looking at your credit report to determine your credit score and whether they should extend a line of credit to you. The good thing about these inquiries, they can only be seen by you, like I said, and so they don't affect your credit score at all, and they don't affect your potential credit worthiness. The other type of soft pulls that you might see on a credit report include any type of account monitoring or account review inquiries. And so if you have a credit card account, for example, just to keep the example with Discover might from time to time look into your credit file to make sure there's nothing potentially noteworthy that might change the terms of your access to credit. The other type of inquiry that you'll find on a credit report is what's called a hard pull. This is a poll or this is an inquiry by a potential creditor who's determining whether or not to lend you money. And this could be by an auto lender or a mortgage lender, or anything where you're asking for that creditor to open up a line of credit on your behalf. These are potentially harmful because if you apply for too many lines of credit, a creditor might look at your credit report and determine you're trying to get access to too much money in too short of a time period. Finally, the other thing that you'll find on a credit report is public record information, and this can include bankruptcy filings, any kinds of foreclosures or tax liens that might be in your file. We're talking about cleaning up your credit. The first thing that you should be doing is regularly getting access to your credit report. As you might know, you have a right under the law to get a copy of your report once every 12 months from each of the 3 major credit reporting agencies. Credit reporting agencies are required to provide you with a copy of your report, and you can get access to this report either online, by phone, or by mail. The easiest way I think to access your credit report is to go to the website annualcreditreport.com. You can just log in, order a credit report. I think the best way of doing this to make sure that your credit report is always accurate and up to date is to stagger requests every 4 months. So that if there is an inaccuracy, it spends no longer than, say, 2 or 3 months on your credit report before you spot it. When you're looking at these 3 major credit reporting agencies' reports, you might notice there's some variation. That's because not every creditor will report to every credit reporting agency. Just note that this variation is normal, but there's likely going to be a large overlap between those 3 credit reporting agency reports. There are also some opportunities where you might have access to a free credit report as a result of being denied credit. So if, for example, you apply for a credit card and you're denied that credit card, they say your credit score is not high enough, or you don't have a long enough credit history, they'll send you a letter, and that's called an adverse action notice. And in that adverse action notice, they'll tell you you have a right to access your credit report. And all you have to do is request a copy of your credit report, and then you can review your credit report to make sure it's accurate, it's up to date, your personal information is correct, and no one has stolen your information. So like I said, the first thing I think that you should consider doing if you want to clean up your credit is regularly get access to your credit report. After you look at that report, if you see any inaccuracies at all, you should contact the consumer reporting agency that's responsible for that report and let them know the information that you think is inaccurate. When you're contacting the consumer reporting agency, include copies of any documents that you think help support your position. And you also might want to include a copy of the report with the items in question. It's important to note that when you submit a consumer dispute reporting agency, they must investigate your dispute under the law, usually within 30 days. So they'll investigate, they'll report back the results of their investigation to you. If your dispute results in a change or correction in your report, the consumer reporting agency must give you the written results and a free copy of your report. And this free report does not count as one of your free reports that you're entitled to under the law. If your dispute does not result in a change, you can still ask that a statement of your dispute be included with your file and all future reporting. So basically, when you review your credit report in the future and when potential creditors review your report in the future, they'll just know that you've disputed a line on your credit report. Finally, if you notice any inaccuracy in your report, you can also contact the creditor or other person who provided the information that's allegedly inaccurate in your report. So, for example, you can write to Discover and you can say, "Hey, my name's spelled with an A, not an O," or you put an extra L in my middle name, or maybe my birthday is wrong in the report. Maybe a creditor said that your payment was late, but in fact it was on time. It's important that you review the report and contact the consumer reporting agency to dispute the information. And if they don't correct it, then also contact the creditor to see if they'll correct it on their end. I think I'm about running out of time, so I think I'm going to switch over to Alan, who's going to talk about credit scores and how to improve your credit score.
Thanks, Pat. So I see we've had a few questions pop up in the chat. I tried to answer one of them. The question was, where can we reliably check our credit score for free? I'll get into that near the end of my section here, but just to make sure everybody saw the answer. Many banks and credit card companies will now provide free credit monitoring services to their customers, where you can check your score for free. Some examples would be Discover, Chase, and most banks nowadays do that. You could also look at third-party companies like Credit Karma to get your credit score for free. So as Pat just talked about, a credit report is essentially a document or file that's going to contain a person's credit history. It's going to list all of their accounts, their balances, and payment history for those accounts. It's going to list all of the creditors and lenders that have been looking at the credit report, and some public information such as bankruptcies. So what is a credit score? Well, a credit score is a number that is calculated based on a formula that considers all the information that's contained in a credit report, and also based on other millions of other consumers around the country. So why are credit scores important? Well, Pat hit on this at the beginning of the presentation. A credit score is just another factor, another element that lenders are going to look at when they're deciding whether to lend a person money, and if so, on which terms to lend that money. So generally, when you submit an application for credit, a lender is going to look at, number one, your credit report. Number two, the lender is going to look at your credit application, which of course will contain information about your income and employment status, things like that. And the third very important thing that the lender is going to look at is credit score. And as Pat alluded to, the higher the credit score you have, generally the better terms you'll be offered if you're approved for credit. So you'll get a lower interest rate, things like that. So what exactly is a credit score, and how is it calculated? Credit score was developed by FICO, which is a company that specializes in what's known as predictive analytics. It basically means they use a lot of fancy math algorithms and formulas to try and predict how people are going to act, what's going to happen. And specifically with a credit score, what this number is trying to do is provide lenders with some information to predict credit risk. Whether or not, the likelihood that a person is going to repay on an account or on a loan. So credit scores generally range from 300 to 850. 850 is considered, perfect score. It's excellent. 300 is not so great, and I'm sure many of you've probably seen there's a lot of graphs out there on the internet that sort of breaks down this range of numbers from poor or bad near the bottom end of the range to fair, good, and then excellent near the top of the range. Again, credit scores are important because it gives lenders a way to analyze risk in a more fair and objective way than if they were just looking at a certain individual's credit report or their application. Because all the information on a credit report and application is individual, specific only to that individual, whereas a credit score adds in that sort of third dynamic of comparing you to other consumers out there. So how are credit scores calculated? Well, unfortunately, there are only a few people on earth that know exactly how a credit score is calculated, and they're with FICO. But we do know some of the factors and elements that go into a credit score. The most important is the number and severity of late payments. That's going to have the biggest impact on a credit score. Other factors include the type, number, and age of accounts. So there are many different types of accounts you can have: mortgages, auto loans, credit cards, home equity line of credits, small dollar loans, and things like that. The number of accounts is obvious. How many accounts do you have? And the age of accounts. The general rule is the older the credit history, the higher your credit score is going to be. And in terms of accounts, the more diverse accounts you have, so the more different types of accounts you have that are in good standing, that will help improve your credit score. Other factors that go into calculating a credit score would be the total debt and the ratio of balances to credit limits. So for example, if you have a credit card that has, let's say, a $2,000 limit, if you're consistently right up against maxing out that credit card, that is not going to be great for your credit score. Whereas if you keep your balance, lower, on the lower end of that range, and continue to pay it off on time, that is something that would improve your credit score. Other factors are credit applications and inquiries. I saw one of the questions, and maybe I can address it now, is why do mortgage pre-qualification inquiries stay in your credit report? It's a slightly different question, but I'll try to answer it anyways. When you apply for credit somewhere, you're applying for a mortgage or an auto loan, and you submit a full credit application, that lender is going to access your credit report to see what's in there and determine whether they want to lend money, and if so, under what terms. When they do that, Pat alluded to it, it's called a hard inquiry. That is going to knock your credit score. So if you are applying for loans all over town and credit cards and mortgages and auto loans, every time you submit one of those applications, your credit score is going to take a little hit. So credit applications and inquiries go into calculating credit scores. I saw another question pop up, but I'll move on for now because of time. Public record information, bankruptcies, things like that will also affect your credit score. What are things that are not considered when calculating a credit score? Race, religion, nationality, sex, marital status, age, those things do not affect your credit score. One of the common misconceptions out there is how much money you make will affect your credit score. It doesn't. Salary, your occupation, your title, your employer, your employment history, and none of that will affect your credit score. Now, that said, creditors may look at your salary and your employment history as a factor in determining whether they're going to loan your money, but that won't affect your credit score. Other things that do not affect your credit score: where you live, the number of times that you look at your own credit score or look at your own credit report. You can look at it as many times as you like, and that won't affect your score. Another thing that will not affect your credit score is the number of promotional inquiries that you receive. I know many of us on this webinar have probably received letters in the mail that say you're pre-approved for a loan or a credit card. Generally, what's happening there is a lender is performing a soft pull, which is sort of a sneak peek into your credit report to see if you would qualify for one of their products, and they'll send out a letter to try to get you to apply. Those soft inquiries, and if you receive these promotional inquiries, that does not have an effect on your credit score. So as Pat mentioned earlier, it's not only important to check in on your credit report and make sure you're following it and nothing unusual is popping up on it, but it is also important to constantly monitor your credit score. Your credit score is not on your credit report generally. A lot of people think that by pulling your credit report, you might find your score on there. It's generally not on there. And until recently, really the only way to get your credit score was to pay for it with one of the big credit reporting agencies by essentially purchasing a very fancy credit report that has your credit score on it. But recently, as I mentioned earlier, a lot of banks and credit card companies are now offering free credit monitoring services if you are a customer. So for example, if you have a checking account or savings account with Chase Bank or a credit card with Chase Bank, you can check your credit score for free using their free credit score monitoring products. There are also third-party companies. Credit Karma is one of the biggest ones in which you can enroll in credit monitoring and take a look at your credit score for Just quickly now, Lorena, can you please move to the next slide? There we go. We'll talk about a few steps that you can take to improve your credit score. And the number one, the most important, is make your payments on time. It is the single most important contributor to a good credit score. Even if the debt is small, it's critical that you make your payments on time. Avoid applying for credit frequently. So this goes to what I was talking about. Every time you submit a credit application to a lender or a potential creditor, they will be pulling your credit, which will ding your credit score. Another way to improve your credit score is keeping your balances under control. If you're constantly maxed out on all your credit cards or your other revolving credit accounts, that's going to negatively affect your score. Another way to improve credit scores is to pay off your debt rather than moving it around. A common pitfall for a lot of folks is opening a new credit line to pay off another credit line. And while that may give you some short-term relief in terms of maybe creditors or collection agencies are calling you, it's not going to do any favors for your credit score because your total debt remains the same. And again, every time you apply for a new line of credit, it affects your credit score. And I'll just make one last point before passing things on to Kevin. These are steps steps to take to improve your credit, but don't anticipate that even if you take all of these steps, your credit score is going to improve overnight. Credit scores are a fluid number that changes based on information that's in your credit report, and it's going to take time. So these are steps that you can start taking, and I encourage you to take, but don't expect results right away. It's something that you have to continually do, and you have to develop a pattern of these good steps. And with that, I will pass things over to Kevin.
Sure thing. Can we go to the next slide, please? There we go. Okay, so I'm here to talk to you about dealing with debt. You've heard a lot from Pat and Alan about, your credit report, your credit score, how important that is, but all of that flows from the debt that you take on, that you owe to creditors such as banks and auto finance companies and so on. And like a lot of us here, I'm sure many of us in this webinar have experience with debt, whether that be student loans, medical debt, mortgage, credit cards. And what if you have problems with that right now? First thing to realize is, you're not alone. We all have debt. Most people face financial problems at some point in their lives, whether that be controlled or uncontrolled, or whether it be expected or unexpected. It could be caused by, unexpected personal or family illnesses, the loss of a job, as we, have all gone through the past couple of years now with this pandemic, or simply not budgeting correctly. And it can be overwhelming, but with a step-by-step process, you can prevent it from going from a bad situation to a worse situation. So the most important thing, I know we've all heard this before, but it's really important to develop a budget to rein in debt. How much you spend and how much you take in is the essence of a budget. And it sounds simple because it is. So what you want to do is always list out your income from all of your sources and then list out all of your expenses. And these are expenses that you want to consider that are more fixed and in other words, things that you can't really alter in the short term. For example, things such as your monthly rent payment, auto payment, your mortgage. Those are things that you can't really change without, signing a new lease or refinancing your mortgage. So you want to list these out. And then you also want to list out expenses that are variable. So things like food, entertainment, clothing, dining out. And by writing all of these down, you can get a better picture of actually how much you're spending, because a lot of budgeting issues is not really taking the time and the foresight to understand what's coming in and out. Just as an example, let's just say you go to Dunkin' Donuts and you get a cup of coffee, and you do that, every day when you before you go to work, and it's $1.50, $2 a day, and you work, let's just say 20-ish days a month, and that it works out to somewhere around, let's say $50 a month. Well, you think $50 a month isn't that so much, but when you step back and think about it, that's actually $600 a year. And not to say you shouldn't go get a cup of coffee every morning. I do. I love coffee. I can't function without it. But it's really important to list out these expenses so you have a clear understanding of money in and money out. And this allows you to prioritize what expenses can you cut back to help rein in debt, and what expenses are necessary and fixed. And the goal is to make sure that you can make your ends meet. In terms of paying down your debt, you need to prioritize paying down debt that is past due first. What my colleagues Pat and Alan have been saying is the thing that affects your credit score the most, which then affects everything else, such as your ability to obtain credit. The thing that affects it the most is late payments or past due statuses on accounts. If you're always behind on a credit card, or if you're always behind on your mortgage payment, that is going to have the biggest, most material impact on your credit score. So when you're figuring out where to apply extra money to outstanding debt, go with what's past due. Aside from that, you should also keep in mind to try and pay down debt that has high interest rates first. So these are things such as credit cards, short-term loans, and so on. That's the reason behind that is obvious. Things with high interest rates accrue interest faster than things with low interest rates. But you want to keep in mind to not just look at the interest rate itself, but also the principal balance of the loan, because that's what the interest is building off of. So for example, let's just say you have a 5% interest loan on $10,000. Well, that's accruing interest faster than, let's just say, 20% interest on a $1,000 loan. Just if you step back and do the math, well, one of them is definitely accruing interest faster than the other, even though 5% sounds like a lot less than 20%. When you if you still have trouble making ends meet after figuring out a budget and applying money in prioritizing towards paying off past due balances, talk to your creditors. And you should do this sooner than later. You can explain to them, particularly during this pandemic era, you should explain to them why you're having problems and try and work out some sort of payment plan to get you caught up. Maybe this is something as simple as, hey, can I get forbearance for a couple of months? Can I move the next few payments to the end of my loan rather than paying now? Or ask your credit card company whether they can take reduced payments for a little bit. A lot of creditors will also offer hardship programs for unexpected events, such as the death of a loved one or losing your job. Often with many of them will offer drastically reduced payments to help you get back to a non-past due status while only accepting, for example, a very small fraction of what your normal monthly payment would be. You want to do this as soon as you can and as soon as you deem it to be necessary, because often when accounts are past due for an extended period of time, they get turned over to a collection agency. And that's the big bad word, the debt collectors that go after people with outstanding debt. You don't want to deal with debt collectors if you can, because dealing with your creditor directly provides you a direct line of communication with the creditor. They're more willing to work with you. They want to keep your business as a customer, even if that means, delaying collecting past due debt for a little bit, rather than handing you off to a debt collector that might pursue you relentlessly, that might file a lawsuit against you to collect money, and that really has no interest in keeping your business. But what happens if you do end up being faced with debt collectors? Well, as I said, creditors often use debt collectors to try and collect debt, especially if that debt is substantially past due. For example, if it's 4 to 6 months or more past due, you might be faced with debt collectors. And these are specialized agencies that call people and try and collect on debt. Federal law does have provisions governing what debt collectors can and can't do. Federal law does not take away the fact that you owe debt. I mean, that is a fact that you can only solve by paying it down. However, it does protect you by requiring debt collectors to act in certain ways. And this law is called the Fair Debt Collection Practices Act. And many states also have a state equivalent of this federal law. For instance, debt collectors cannot call you early in the morning or late at night. They can't call you if you tell them, hey, I work at a job at a certain time, please don't call me at work. They can't call you if you tell them that. They can't harass you, they can't lie to you, they can't be abusive to you. And if you ask for them to verify the amount of the debt, they have to do so. They have to respond to you and to provide you a validation of the debt. If you, for example, tell them, hey, please stop contacting me a certain way, they have to honor that. So you have to remember, debt collectors, if they call you 3, 4, or 5 times a day, it might be really annoying, but there are certain things that they cannot do. And you should tell them that if you feel like you are being contacted in a way that violates federal law. I just want to cover 2 things really quick that are a little bit outside the scope of this webinar, but because they can be entire presentations on their own. But one thing would be if you're really backed up in a corner, you could consider debt consolidation. So there are various ways of doing this. For example, there are certain creditors that are willing to pay off your debt and consolidate it into one single line of credit that then you owe to them on a new terms at a new interest rate, for example, or a new payment schedule. But there are others such as, like, for example, with credit cards that are often balance transfers, particularly for a lot of credit cards that might offer some sort of promotional 0% or a low interest rate for a period of time when you either open the credit card, or they might be offering that sort of program to entice you to use a credit card that you haven't used in a while. I know I get those kind of promotions all the time. That might be something to take advantage of in order to try and minimize the amount of interest that you have to pay. The last resort is bankruptcy, which has a whole can of worms to open. And the most important thing to note for a bankruptcy is once you file a bankruptcy, all of your creditors will be notified and it will appear on your credit report. So you have to be really sure if you want to file for bankruptcy, even if you don't end up getting discharged of your debts through the courts. A bankruptcy can land on your credit report for 10 years. It can make it very difficult after the bankruptcy to obtain credit, to buy a home, to get life insurance, even maybe to get a job or to rent an apartment. However, this is a last resort legal option that provides a quote unquote fresh start by discharging most forms of debts, with the main exception being student loans. If we can go to the next slide, I'll finish up quickly. So I know I went through a lot about how to sort of pay down and manage debt, but I wanted to briefly cover debt relief programs. So in general, when you feel overwhelmed with debt and you feel like you've lost control of your finances, it can also seem really appealing to turn to a business that's advertising to you, that's offering help to solve your debt problems. However, you want to be wary of these companies that advertise something that sounds too good to be true, because often it isn't. For example, a company can't magically make your debt go away unless they're offering to actually pay off your debt, which I've never seen any company do. Unless they're offering to do that, they can't make your debt go away. What they can do is they can try and get some of it off your credit report. They can try and negotiate with your creditors to make more make better terms for you for repayment. But these are all things that you could have really done yourself by contacting the creditor. So before you engage with any such companies, do your basic research. Look at the Better Business Bureau reviews, contact the BBB, contact your local consumer protection agency or the state attorney general's office to see whether this company is legitimate. And just be wary of advertisements and commercials of companies offering debt relief. It might really be that they're actually offering bankruptcy services, like, for example, to file a bankruptcy on your behalf, which does technically provide debt relief. So what they're advertising is true, but it's really a last resort. These things can really ruin your credit and your credit score, even though it's providing you debt relief. Moreover, it's not necessarily free. I mean, these companies are for-profit businesses. Their services often cost money in the form of attorney's fees and court costs, for example, in bankruptcy. I want to talk a little bit about scams. Often people are targeted with credit repair scams when they are looking for debt relief. It's usually you see something along the lines of like, erase bad credit guaranteed, or hey, we can remove things from your credit report and we can create a new credit identity for you. That's just, it's just not true. One of the easiest ways to see whether or not a company is providing legitimate credit repair services is to see if they will provide you at the outset with a pamphlet or a brochure that's called the Consumer Credit File Rights under state and federal law before you engage with their services. This pamphlet and this law would explain to you that a credit repair company can't make any false claims about their services. They can't charge you until they provide the so-called credit repair services. They can't perform any services until they have your agreement in writing to do those services, and also a 3-day waiting period during which you have the right to cancel any such agreement to do those services without paying them anything. The pamphlet needs to explain the total cost of those services, a detailed description of what they're going to do, how long it's going to take to achieve those results, what they guarantee that they can do, as well as the company's name and business address, which is harder to find than you think sometimes. So you want to avoid businesses that want you to pay, for example, want you to pay for credit repair services before those services are actually provided to you. You have no guarantee of what they can or can't do. And again, they can't remove things from your credit report. That's not a thing. And these companies also have an obligation to tell you of your rights and what you can really do yourself for free without paying them at all. And the biggest risk that you face when engaging with these credit repair companies that may not follow the law is if you do follow their advice and their advice turns out to have legal ramifications, you might be liable for any fraud that's committed. You might be subject to prosecution. You might be charged and prosecuted for mail or wire fraud if it requires any sort of application for credit or providing false information, and so on. Last but not least, I wanted to talk about identity theft because often we get questions about identity theft associated with talking to credit repair companies and so on. Identity thieves can get your information through all sorts of methods. I'm sure, it's 2022 now. I'm sure you've heard of all sorts of stories of identity thieves getting people's information, particularly with, giant leaks associated with the credit bureaus that we were talking about earlier. But why is this important? Well, your information is important, and it's important to keep it secret because identity thieves can open credit accounts in your name. They can obtain access to your existing accounts. For example, they can call your bank and pretend to be you, or they can open new accounts. And that's why it's important to keep a watch on your credit report and to order it at least once a year or every 4 months as past adjusted, to keep an eye on any accounts that might be on the report that you don't recall opening at all. They can also obtain information from existing accounts that they can then use to wreak more havoc. So it's important to read your credit card and bank statements carefully. It's important to shred information that contains personal information instead of just tossing it in the trash. It's important to safeguard your online data so that you don't get hacked. Unfortunately, you can't do much against leaks that contain your information, but you can stay vigilant and keep an eye out for any fraudulent accounts that may be open. And last but not least, if your identity does get stolen and you do realize that accounts have been opened in your name that you did not open, it's important to place a fraud alert on your credit reports with those credit bureaus, as well as with your creditors, so that we can at least stop the issue at that point in time and stem the destruction, so to speak. To get these accounts closed and to file a report with the FTC as well as your local police, and take those reports and give them to your creditors so that they know what's going on and they can talk to the police and the FTC directly to rectify the issue. I think we have some time for some Q&A. I see there's.
Yes, let's see. Hello, thank you very much, gentlemen, for sharing all of that with us. Let's see, Patrick, I know that you've been keeping track of some of the chat. I don't know if you've seen if you have access to the Q&A box on the bottom also. Just want to check in on that part.
Yeah, I think we've answered most of them. Feel free to follow up with any additional questions. I know that Alan and I have been typing away here while Kevin's been speaking, trying to answer the questions.
Yeah, Pat, could you just read out some of your answers for the benefit of the folks who can't see this, or folks who have called in?
Yeah, sure. So an anonymous attendee asked, what debt should we pay off first? Credit cards, loans, or do interest rates matter more than the type of debt? And I think this was following up on a point that you made, Kevin, that generally you should pay off the debt, the highest interest rates first, which, as you noted, makes sense because these are the creditors that are charging you the most money for the loan. Just parlaying on that, it generally makes no sense to pay off the highest interest rate loans first because you're paying the most for those loans. But then again, all things being equal, you should also consider the amount of money in the account. If you've got a very small account, and you can pay off that account and reduce the number of delinquent accounts on your credit file, then you should also consider doing that too. Stephen S. asked about a balance transfer to an existing account and whether that can negatively impact your credit score. Generally, a balance transfer is going to have little or no impact on your credit score, assuming that the other things remain constant, which is to say the number of accounts you have remains constant, your credit utilization remains constant, and your overall debt remains the same. Let's see, what else do we have here? I think Alan talked about free credit score monitoring during his presentation, and then answered a question about that. I know Credit Karma is great. The various CRAs have apps that I think are really good as well. There are a couple of questions about pre-qualification. Sorry, Alan responded and noted that hard inquiries generally stay on your credit report for 24 months. And then just to follow up on that, pre-qualification is important just because it gives creditors a sense as to how big of a credit risk you are. Like Alan noted, if you're going around town and you're looking for loans, 2 or 3 times a week, and you're desperately trying to get access to credit, then you might be at higher risk than someone who might be, looking for 1 new account every year, 1 new account every 3 years. What else do we have here?
I think we have a couple of open questions on the Q&A panel, which I can take a stab at. So Jay asks, is the monthly interest amount determined by the total loan amount or the balance each month, assuming you're paying it down on a monthly basis? Well, it really depends on the type of loan and how that loan is structured. But assuming you're talking about a regular loan that has what's called simple interest, then, oh, excuse my cat in the corner there. So the interest will be calculated based on the outstanding principal on that loan. So the interest, the accrual of interest actually gets smaller and smaller over time, even though the rate of interest is the same, because you're paying down on that principal over time. So what might seem like a large amount of interest accrual at the beginning of let's say a 5-year loan, 5 years later, if you've been paying it down month by month, later on during the loan cycle, more and more of your monthly payment would be applied to principal rather than to interest. An anonymous attendee asks, what if you can't consolidate your debts because you have a bad credit score? Well, you gotta work on improving your credit score then by first and foremost, really just looking at your accounts, identifying ones that are past due, and prioritizing payment on those accounts. Though, like Alan said, this isn't sort of some sort of magic bullet. It doesn't, change your credit score overnight. But over time, if you can get those accounts caught up, your credit score will almost certainly go up. By how much? I mean, that's anyone's guess. These formulas are proprietary, and also it really depends on your own current situation, what accounts you currently have, the debt that you currently have. But getting accounts caught up so that they're not past due, even if they still have a balance, so long as they're not behind, is almost the most surefire way of improving your credit score and opening you up to other options such as debt consolidation.
Yeah, and I'll just quickly tack on to that. There are a number of different debt consolidation companies out there. Generally, they're going to require a credit score of 640 or 650 and above. But there are what has been termed as bad credit debt consolidation companies. It generally means they're willing to use a lower credit score. Sometimes it's 600, sometimes it's even lower. So I would encourage you to certainly shop around before doing anything. But as Kevin mentioned, sometimes the best step to take is to simply try to increase your credit score. And if you have to wait a little bit until that increases, that might be the best step. Otherwise, there are other more serious alternatives that Kevin had mentioned, bankruptcy, for example. So those are sort of the last, case scenario if these other steps don't work.
And we also have a question as to whether we will have access to the recording after the presentation.
I can take that one. The answer is yes. We will make this available to everyone who has registered for the program, and we will post it on the library's YouTube page as well. But if you have registered for this program, you should automatically afterwards get an email that will contain both the slides from this presentation and also a copy of the recording so that you can review it.
Great. Do we have any more questions?
Anyone else, feel free to type into the chat. I have put there, I hope the presenters don't mind, the FTC's website, where they do have information on good sources for getting your free credit reports, as well as how to report identity theft, prevent identity theft. And then also the links to register for the February 22 session on buying and selling a home, which you can register for either through Chicago Public Library or Evanston Public Library. It doesn't matter, you'll get the information either way. So any final thoughts, gentlemen?
If there's no further questions, I have no further thoughts.
Well, thank you so much. Yeah, thank you, Lorena, so much for setting this up and for the opportunity, and thank you everybody for attending. We love doing this, and we hope to see you at future events.
Yes, thank you very much to Kevin, to Patrick, and to Alan for taking the time to join us tonight and share their lovely assorted background views with us as well. So cats, dogs included.
Thanks, Lorena.
All right. Thank you, everyone.
Okay, thank you, everyone. Have a good night.